Mhm. Oh, we gotta go to show mode, right? Show mode. Here we go. Yeah.
Hello and welcome, everybody. Today we have Phil Flynn, Senior Energy Analyst of the Price Futures Group. Phil is also a Fox Business Network contributor. He is one of the world's leading market analysts, providing individual investors, professional traders, and institutions with up to the minute investment and risk management insight into global petroleum, gasoline, and energy markets. Mr. Flynn's precise and timely forecasts have come to be in great demand by industry and media worldwide. His impressive career goes back almost 4 decades, getting attention with his market calls and energetic personality as a writer of the Energy Report. Phil, the floor is yours. If you need anything, I'll be right here.
Thank you, Sam. Thank you. Thank you. And welcome everybody to another wonderful event here. Those of you that don't know me, I'm Phil Flynn, Senior Market Analyst at the Price Group, as well as a Fox Business Network contributor. Talking today mainly about oil. We're going to be talking a lot about commodities. And commodity futures obviously are very risky. Read the risk disclosure if you're thinking about trading commodities. They shouldn't be traded by anybody who's sane. So that's why I'm so good at it, because I'm a little bit insane. No, actually, it's going to be interesting. But I think what we're really here to talk about is energy, right? And a concern that I have had that I think everybody here needs to know about for their investment portfolio is the false perceptions of what is being fed to the market as far as an oil glut, right? And we're going to get into that a little bit, but why this is really significant because this talk of a so-called massive oil glut could lead you to make the wrong decisions and not be prepared for the potential risk of an upside price spike in oil. And we're going to get into that a little bit. But first of all, let's talk about where the rumors are really coming from of this so-called massive oil glut. We're talking about the glut of all gluts, right? The mother of all gluts. It's going to get bigger. It's going to be unbelievable. It's going to be even bigger than COVID. Really? According to our friends over at the International Energy Agency, they're trying to tell us that global oil markets are on track for a record surplus year, and that supplies are going to swell, that oil inventories are going to accumulate at a rate of 2.96 million barrels a day, surpassing the average buildup during the pandemic when we shut down the freaking economy. The International Energy Agency oil balances look more bloated as forecasts as far as supply eclipses towards year end in 2026, noting it's clear where something's going to have to give to get the market in balance. I think what's going to have to give is that somebody's going to have to give medication to the International Energy Agency because these guys are all wrong. I mean, when you look at what they're saying here, they're saying that we're basically going to shut down the economy. They're saying that OPEC is going to flood the market with oil, that we're going to have this massive glut and prices are going to be low forever. Don't invest in energy. But you have to look at, who's starting this narrative, Um, when you look at the International Energy Agency, they have been one of the worst projectors of oil demand and supplies probably ever. And one of the problems we've had with the International Energy Agency has basically been that they've become a political animal. Like so many institutions, they've lost their focus on what their job was, okay? And the International Energy Agency's job was very simple to secure, to have energy security for Europe and be prepared to meet demand. So that's your mission, right? Make sure you can keep the lights on. You have to be prepared in case OPEC, decides to band together and cut off oil supplies and try to bring down your economy, right? That's your job. But they lost that mission. All of a sudden, they became a think tank and a mouthpiece for the green energy industry, right? They tried to convince us that we didn't need to invest in fossil fuels a few years back, that we didn't need to because we have to get net zero. But they didn't take into account for a fact that the real demand for oil continues to go up, and that even if you looked at their own data, it didn't suggest peak oil demand, but that's what they were trying to feed everybody. Why? Ultimately it's so prices could go higher, so alternative energies made sense. And in my opinion, I think it's because the green energy movement wants more control, not over only of the global economy, but over our lives, right? If they can give you interruptible power sources, they can interrupt your life. They can control you a lot better. They can shut down the economy and tell you to stay home. In fact, there was even talk that they were going to have a shutdown of the economy for the environment. So if we shut down the economy for a week and send everybody home like we did during COVID, and then we wouldn't burn as much greenhouse gas emissions. I mean, these people were crazy. But if you go back and you look at their track record, they had to reassess their demand estimates, going all the way back to 2007. This was a little while ago. The demand for oil in 2019 was revised up, and even that was low. So if you look back at their track record, you have to wonder why they're making this prediction and whether or not we see evidence of what they're saying is true, right? So when you have to go back and say, oh, yeah, by the way, for the last, from 2022 back to 2007, yeah, we got that wrong. Everybody has a bad, decade or two, right? Don't worry about it. But the problem is when you have an agency like the International Energy Agency, and they're trying to, people are making decisions based upon this, and businesses, it becomes very dangerous, right? Especially if you have to question their motives, behind their calls. And so I really have to question the recent call of this massive oil glut. And I ask you, does it make sense that we're going to have this massive oil glut? We have US oil production kind of at a record high, but signs it may be slowing. We're going to get into that a little bit. Are we going to shut down the economy? Are we going into a major recession? Well, that might slow down oil demand and create a glut, but the stock market's near record highs, and even with some challenges in stocks, we're not seeing any signs of a major recession where things will be shut down. In fact, in their own data, they still indicate that global oil demand grew by 2.2% faster in 24, faster than the last 10 years, right? This is the same agency that predicted peak oil demand, back during COVID. So what I'm saying is that they missed it not only on the supply side, they missed it on the demand side by a long shot, right? And what we're seeing here is that the International Energy Agency is really making some calls, I think, based on politics and not based on fact, right? We have the same thing here, I think, with the Federal Reserve a little bit, right? Or at least that's the talk, right? We got a bad jobs number. The Federal Reserve didn't want to cut interest rates. Their base case was, well, Donald Trump's tariffs could cause inflation. Folks, tariffs don't cause inflation. The only thing that causes inflation is government spending, and any economist worth the salt could just look at the history of tariffs and see, did they ever cause inflation? And the answer is no, it never has. Now, does it make some prices go up? Absolutely. Some prices could go up because of tariffs, right? But other prices would end up going down. And there's a balance. In fact, if you look at the tariffs under Trump 1, we actually saw a lot of prices go down. Inflation went down, not up. And during the Great Depression, does anybody think inflation was the problem? Of course it wasn't. It was deflation. I guess you could argue that tariffs could be deflationary, but to make a fiscal judgment on that is bad. But you know why it's dangerous? Dangerous for our economy, but it's dangerous for our future, because if we live in this la-la land where we think, oh my gosh, we're just going to have alternative energies and we're all going to be driving electric cars, you better wake up. ExxonMobil isn't buying it. They're coming out pretty much with a warning that sustained oil and gas investment is more important than it ever has been before, almost. They said oil and natural gas supply from producing wells naturally decline over time, which requires investment in new and existing fields to meet demands against all scenario. That just came out in the recent report. This isn't old stuff. This is today. And Exxon is right, and I think the Trump administration gets this. We have been underinvesting in oil and gas for a long time because it wasn't pretty. It gets your hands dirty. It wasn't politically correct. We told bankers, don't invest in oil and gas. What are you, crazy? The new thing is going to be green, 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 green. Well, the green went into the pockets of the politicians. It didn't lower the cost of energy. It raised the cost of energy. It put undue burden on the poor and the middle class, right? And it's been an abject failure. That's not to say that green energy can't be a part of the solution. It is part of the solution. But to try to demonize one energy sector and try to replace it with a subpar amount of energy or production or capability, it's just madness. And we have to reinvent that right now. Now, this is Oxford, okay? Oxford Energy. They're pretty good. They have a name like Oxford. It sounds pretty impressive. That's it. It does. Very impressive. And they are very impressive. Um, and from their insights, they were saying in the third quarter underway, the dominant narrative has been one of a massive oil glut, but one in which stocks have not been building. In fact, in the most visible locations, in the market remain backwardation. So backwardation, of course, is when the prices are suggesting that supplies are tight, right? Not, the higher prices are up and the backwardation. So the common view is that the oil glut is being translated into the buildup of stocks in non-OECD, mainly in China, one of the least transparent locations in the world. But many uncertainties remain about how big these increases are and the motives behind the accumulation of these stocks and the factors behind the wide divergence in stock builds across the various geographies and factors like China's decision to continue building stocks or release them to the market. Okay. So there's a lot to unpack here, right? They're saying, well, the market's kind of suggesting there could be an oversupply, but if you look at the actual oil inventories, they're below average everywhere you look. If you look at the US, below average. You look at inventories below the 10-year average. But then you see these markets kind of suggesting, well, maybe they're hidden in some secret Chinese location. They've been buying a lot of oil. And the question is, why are these dynamics so screwed up? Why can't we see this? Is it just because of China? I think part of the reason is because the previous administration broke the normal market dynamics. And how they did that was by releasing a bunch of oil from the Strategic Petroleum Reserve strictly for political purposes and not because the world needed more oil, right? So when you have a market that doesn't need more supply and it gets flush with supplies, yes, it brings down prices, but it also breaks the normal market dynamics that you normally have, right? So if supplies are so tight, why are U.S. energy, or if we have such a big glut of supplies, why is demand at a record high? And we're going to get into that a little bit. So the point is that the markets, because of free oil on the market, um, hasn't acted normally. It broke the normal market dynamics. And because of that, we're not seeing a normal supply and demand response, which is leading to these mixed indicators, so to speak. All right. But the bottom line is that crude is going to be in demand for a very long time. We are underinvested in crude oil. Even though we're seeing some signs that producers are struggling right now, at the end of the day, if you look at where we're going to be as far as energy demand, whether it's artificial intelligence, whether it's factories, we're not even close to investing enough money currently right now. Um, One of the things we've also seen that doesn't really suggest a oil glut is that if you look at the crude storage in very large crude carriers, this is from Kepler Research, it's been tanking, right? So usually one of the places you look to see where the oil is being stored in a glut, um, you would imagine that it would be showing up. But if you see where it's going right now, it's actually been falling pretty dramatically. So if you have an oil glut, you would figure that storage would be filling up, not emptying. So this doesn't seem to fit the dynamic of this massive oil glut. So that brings us to OPEC, right? Now, one of the big arguments is that OPEC was going to flood the market with supplies. And that was going to bring oil down to the 50s and to the 40s, right? Um, and what do we have? OPEC this week, they tore up their flare book. Remember, they had the voluntary production cut a few years ago to offset the oil that we got from the Strategic Petroleum Reserve. So they're going to cut production to, level out the market and work off that supplies. Well, they're speeding up their plan now to reverse those cuts, and they announced that this week. And the talk in the street was that they're rolling back the remaining 1.65 million barrels a day, drip feeding the market of 137,000 barrels each month. Um, but the question I'm asking and then asking, is this about getting market share? Is it about flooding the market so prices will crash? Um, but you got to watch what's happened today. Now, today, when we talk about this number, it's like, oh, by the way, we're going to be adding these barrels back to the market. Supplies are below average. OPEC denies it's about getting back market share. They're telling you it's because the world is demanding this oil. And that's one of the reasons they're able to raise it. And as far as flooding the market, when we take a look at what's happening with the actual cut, we have to talk a little bit about the so-called compensation cuts. And what that is the cheater, pumpkin eaters, the OPEC countries that were cheating, like Kazakhstan, Iraq, Russia, the UAE, Kuwait, Oman, they were all overproducing during this period of time. So as they were overproducing, did we see stocks go up dramatically? No, we haven't. They're still below average, and diesel especially. That's going to be something that we get into. Um, they're below average here in the United States with crude or gas. I'll get the latest numbers. Basically, we've got a very tight market. We don't have an oil glut. You could say the market's balanced. I would say maybe balanced with a upside risk. I would definitely say that because the market's gone nowhere. And I think the market's always right. But when you start adding the cheater barrels, so you're subtracting maybe 137,500 per month. But if you look at the compensation barrels are actually going to go up, which can actually mean an OPEC production increase of anywhere from what's the number here? It's up to 190,000 barrels a day, right? No, from the low end, 190,000 barrels a day. The up end could be up to 829,000 barrels a day. So if you do the math, while some producers are cutting back, you're actually going to be seeing increases that will totally wipe out this so-called production increase. Um, and so, in other words, you're not going to be getting an increase from OPEC. You might actually be getting an OPEC cut. It's what we call fuzzy OPEC math, right? So when you get these headlines, oh my gosh, OPEC's taking away their cut and they're going to raise production by 137.5 million barrels a day. Then if you read the small print, it's like, well, if the cheaters stop cheating, that means we're actually going to see less real barrels on the market. Now let's get back into U.S. production. President Trump, of course, is drill, baby, drill, and prices have been low, but it's come at a cost for the U.S. shale producers. Right now, U.S. shale producers are having a very difficult time adjusting to these lower prices. Again, part of that is because of the Biden administration. When you released a lot of barrels of free oil on the market, it reduced prices, it reduced investments, it messes up the market, right? How would you like to be selling, you know, potato chips and the demand starts going up a little bit and then the government releases 50 million tons of potato chips on the market, right? What does that do to your business? You start investing to make more potato chips? Of course not, right? And that's what's happened in the oil industry, and they're still reeling from that government intervention in the market. So rule number one, when the government gets too involved in a commodity market, there's all these ramifications, and we're going to be paying for that. We're paying for it right now in the U.S. energy space a little bit. But there are brighter days ahead, because if you look at the demand side of the equation, for energy and U.S. energy, it's going to be the best of times. Once we get through this rough spot, we really expect to see energy take off. In fact, if you look at energy in a portfolio and you look at the overvaluation of a lot of the stocks, the energy sector is undervalued, right? So a lot of people don't have as much exposure to the energy space because it's been kind of a dog compared to, some of the AI stocks, right? Um, but we think with AI and the demand for energy as a whole, energy is going to play some significant catch up. And I think we're getting close to that right now. In fact, even in the International Energy Agency's mid-year update, they're expecting global electricity demand to grow by 3.3%, maybe as high as 3.7%. Now, remember, they usually underestimate demand. So I'm assuming that's going to be a higher number, right? And I think it's going to be a higher number. And it's going to be significantly higher than the average of going up 2.6%. So we saw a 4.3% surge in energy demand in 2025 and 2026. And of course, they've up those. In 2035, the forecast is 6% higher than they forecast just a couple years ago in 2023. So in other words, they're already upping their previous estimates. They're going to have to up these estimates as well because, and this is the thing, the International Energy Agency, when they said stop investing in natural gas, stop investing in oil and gas, stop investing in coal, get in wind farms, where do they think the electricity was going to come from? From the electricity, you know, I don't know, the electricity, do they have electricity? I don't know, fairies or godmothers? I don't know. But the reality is that if you look at this, this means we're going to need a lot of natural gas, potential nuclear power, but it also means natural gas investment in oil. In fact, as you probably have heard, a lot of these private companies are trying to secure their own energy because the US power grid is aging and it has to be upgraded. But a lot of these companies are buying their own energy, creating their own energy plants, buying natural gas production to power their artificial intelligence. So if we're going to meet the demands of the future going forward, energy is going to be a big part of that. And we have to be on the front hike, right? Now, when we talk about this production hike from OPEC, is it going to matter, right? And this is a warning from Gunvor. They're saying the OPEC supply hike will likely undershoot their plan. So there's a lot of talk that um, OPEC is probably producing, or at least a lot of the OPEC producers can't raise production any more than they already are, right? And so this is going to be a huge situation. So if the Saudis are only going to raise production by a modest amount, we're going to get into a very tight market situation. The US is going to have a hard time raising production because they've been cutting back rigs. And probably the only thing that's going to change that is a potential price increase in oil, which I think we're going to probably get. Now, I think we're going to get it partly because of the supply and demand dynamics, but I also think we're going to get it because of the geopolitical risk factors, right? Obviously, one of the things that we've had some things that have happened today um, between Israel and Hamas, and a historic thing happened today. Probably a lot of people watching this may or may not know this, but Israel attacked and tried to assassinate Hamas's leadership, which you might say, well, what's the big deal? They've taken out every Hamas leader over the last couple of years. It's a job you don't want unless you want to get assassinated, right? Hey, help me, Hamas leader, come on, easy gig, if you can stay alive, right? But the key thing was that they did it in Qatar. Qatar or Qatar, depending on how you prefer to pronounce it, it's kind of like the Switzerland of the Middle East, right? They're kind of like in between. Not everybody, they get along with everybody. They don't get along with anybody. But the Hamas leadership thought they'd be safe in Qatar from attacks from the Israelis. But apparently, with the US blessing, Israel attacked the leadership. I haven't heard reports whether the leadership was actually killed, but it raises a new dynamic in the market as to how will Qatar react to Israel, carrying out for the first time ever a military operation on their own soil. So this is going to be a very uh, delicate situation. And this comes, of course, as we have the Russian-Ukraine war, which is continuing, and with the real possibility of major impacts on the price of oil. And one of the things um, that we have seen um, is that President Trump, of course, is warning of massive sanctions on Russia if they don't come to a ceasefire. That deadline's coming up quickly. And the possibility of them going after Russian oil with sanctions and secondary sanctions on any country that buys Russian oil, and threats by some of the administration that the Trump administration could absolutely destroy the Russian economy. But they could also destroy your economy if you're not prepared for an upward spike. Because if that actually happens, one of the concerns you're going to have is diesel. As I mentioned before, U.S. producers are struggling right now, especially in the shale patch. Baker Hughes has been sounding the alarm, so we did mention this a little bit. Rig count did tick up to 537, but we're still 45 rigs below a year ago. This came out last Friday, I believe last Friday, and it's a drop of 8%. Crude rigs are making a modest comeback, but they're 14% below where they were a year ago. Natural gas rigs have been in retreat, slipping by one, but natural gas rigs are actually up 26%. So there's something going on in natural gas here. Natural gas has looked horrible, but going back to what we said about the artificial intelligence revolution and the increase in LNG exports, the outlook for natural gas looks good. So at these price levels, we like natural gas. Probably a good time to get geared up for winter. Look at the back end of the curve, right? Um, and so when we get into this a little bit, but we also hear from people, and here's somebody who does taxes, I believe, for the energy companies, and they're saying that the price of oil at $63 a barrel is hurting everybody. It's hurting people in the oil patch, people that get big oil companies are in the news, but it's the independent oil producers who are the backbone of this country that have been getting hurt by these low prices. And that lack of investment means that the US oil production could level out, actually peak, which could lead to further tightness in the market and create a price spike. So, where I'm really concerned more than anything is diesel and natural gas, right? So, we're going to get into what's next for oil and gas, but diesel and natural gas. Diesel, why I'm concerned about diesel, right? Diesel's made by heavy oil. Russia produces heavy oil. Russian oil could be off the market. Okay, that's number one. Venezuela, heavy oil. U.S. refiners love Venezuelan oil, make a lot of diesel. Our refiners are built for Venezuelan oil all along the Gulf Coast, the Gulf of America coast. Got it? Not Mexico. Anyway, straighten that out. So, heavy oil at risk. If Venezuela's drug running was attacked by the Trump administration, this could lead to further tensions, potential shutoff of supplies. If that happens, obviously, we could have a big problem with diesel supplies. In Europe, of course, diesel supplies, we were living on fumes last year, and they're trying to get off Russian oil. They're making more plans to get off Russian oil. The problem is, how do you replace that heavy oil? It's very difficult. And that's one of the things we've been looking at. One of the reasons why the diesel crack spread, which is the amount the refiners get from turning oil into diesel, has been on the rise. So it's definitely something that you want to take a look at. Then we look at the crazy geopolitics here. Phillips 66 is shutting down a refinery. California capacity is down. Gasoline prices could be soaring, which could be absolutely, through the roof. So if you look at everything that's happening from the green energy front, it's going to potentially lead to sharply higher prices unless there's a reverse. Now, the good news is we're starting to see signs that people are getting this, okay? So again, OPEC cheaters making compensation cuts, we went through the numbers. That's going to take away the so-called glut, right? ConocoPhillips is laying off part of the workforce, more sign of pain, but also signs of a bottom in the market. Usually, when the big producers start cutting back, that's usually a sign that the market's getting ready to turn. And President Trump, drill baby drill, it's going to be challenged right now because prices are low. But if you look at the big picture, President Trump's on the right track. And I think if you talk to people in the oil and gas industry, they're not happy that President Trump has been rooting for lower oil prices. But I think they know that the president has their back. And so when this incredible surge comes, we're going to be able to respond to this supply squeeze faster than any time in history because you won't have to cut through the government red tape and the potential lawsuits and the crazy actions of past administrations that's really made U.S. energy kind of the enemy when it comes to the world, right? And their globalist agenda. So when we get through this, I think what we want to take out of this right now is that we think you have to put oil on the agenda right now. This oil, gas, we think we're near a cyclical bottom. We think that the demand is going to be higher. And so when you start hearing from agencies that are politically connected and have been consistently wrong, when they start talking about a glut, when they start telling you that tariffs are going to hurt energy demand, when they start talking about President Trump is going to be horrible for the economy, he's going to push us into the recession, listen to where they're coming from and look at their track record. Have they been right before? Were they right that U.S. oil demand was going to, or oil, U.S. or global demand was going to peak out? Were they right that we should have stopped investing in fossil fuels 10 years ago? No. And you have to look at the agenda. So don't let their political agenda have you miss out on looking at the risk to your portfolio. And so if you look at the stock market as a whole, there's a lot of concerns about overvalued stocks. Well, you know, from this type of viewpoint, you would think if some stocks are overvalued and you're heavy in the overvalued stocks, you might want to move some of that portfolio. You might want to, maybe not, to some of the undervalued energy stocks because energy, I think, is ready for a new golden age. And I think it's going to be happening soon. Artificial intelligence needs a lot of energy, data centers, and it's all going to come back to drill, baby, drill. And I think I'm off my soapbox. I'm checking my time. I think, do we have time for questions or?
We could squeeze in a few here. First, I'm going to
Okay.
just read off from Edward. Thanks, Phil, for this unique and very revealing new video facts that we do not get anywhere else. And for questions, we've got several. Phil, where do you see the price of oil for the rest of 2025 and 2026?
Home, home on the range. I mean, I feel like it's Groundhog Day. I feel like I'm Bill Murray waking up to Sonny and Cher every morning when it comes to oil, right? I mean, we've been in the same darn trading range, probably for at least a year, right? My sense is as we get closer to winter, we're probably going to do an upside breakout towards the end of the year. A lot of people have been talking about a downside breakout, below 60 into the 50s, into the 40s. I really don't see that happening unless there's some major event. So if you look at, for easy terms, low end 60, high end 70. Yeah, we had an outlier down to 55 for a couple of days. We had an outlier on the upside to 75 on the attack on Iran. I would say that we're much more likely to test the Iranian attack highs before the end of the year than that $55 low, right? In the meantime, one of the strategies you might want to consider, because we've been going sideways, have a bullish position, hedge it with options perhaps, get long futures, maybe sell the call, maybe buy some calls. That might be a way to do it in the futures with limited risk. Again, you have to check your risk tolerance, and we can help you with that. I do Also, too, you can swing trade it. We put out daily trade levels every day on oil and gas, so you can take advantage of those swings using the support and resistance points that we put out. And anybody that emails me or pflynn at pricegroup.com or calls me, we'll make sure you get on that list.
Okay. That's all we really have time for. Thank you,
Oh,
Phil,
come
for the
on.
presentation.
Well, I feel bad if I talk too much. I didn't get your questions in. But if you still have a question, email me, pflynn at pricegroup.com. I'll answer you personally to make up for the fact that I talk too much.
No, you're fine. You're fine. Thank you, Phil. Thank you for being here. Thank you all for joining us. We have more in store today. Check out the agenda on the virtual platform, and we hope to see you in the next session. Thank you, everybody.
Thank you. All right. Thanks, Sam.